Investing is one of the most important activities in your life. It can also be one of the most confusing, especially if you're just getting started. After all, investing can seem like a vague concept that's meant for more experienced and financially secure individuals. However, it doesn't have to be as difficult as you might think. In fact, with a little bit of research and some common sense, investing can be a lot less intimidating than you think. It also doesn't have to involve hundreds or even thousands of dollars. Either, in this post we'll dive into some key insights that anyone can implement right now, regardless of your financial situation, to start saving money and growing wealth faster than you ever thought possible. What is investing? Investing is the purchase of financial assets with the intent to sell them at a later date for a profit. In other words, it's the process of acquiring assets such as stocks, bonds, real estate, and commodities with the intent of reselling them at a higher price when the time comes. Investing can be done in a variety of ways and with a variety of assets. The key lies in identifying the types of assets that are most suitable for your situation and sticking to them. This way you'll be able to grow your wealth much faster and with much less risk. It'll also give you the peace of mind that comes with knowing that your money is being used effectively and responsibly. A quick history lesson. Before we dive into the key insights, let's take a quick look at how investing has evolved over the years. In the early 1900s, there was no such thing as investing. People instead had to rely on stocks, bonds and other assets that were controlled by banks and other financial institutions. Back then, you couldn't just buy or sell these assets whenever you wanted to or for whatever price you wanted to. It was all dependent on what the bank or financial institution thought it was worth. This is why most people didn't have much money in their hands back then. Most of their money was tied up in stocks and bonds that they couldn't sell whenever they wanted to at whatever price they wanted. This is also why many people lost a lot of money during the Great Depression when banks began collapsing left and right, and often taking people's hard-earned savings with them. After the Great Depression, President Franklin Delano Roosevelt created a new system called Social Security, which introduced something called personal retirement accounts. This allowed people to save money for retirement in a completely different manner than ever before. Now people could save money directly from their paychecks into personal accounts that they owned 100% and could withdraw from whenever they wanted to without having to get permission from anyone else. Why invest? Investing is a great way to make money. It can also help you reach your financial goals faster, like retirement or buying a house. There are many reasons why you should start investing, and some of the best reasons are the interest you earn on your money. This is arguably one of the most important reasons to jump on the investing bandwagon. Not only will it increase the amount of money you end up having in the long run, but it will also give you a nice little income each month. It's a long-term investment. You don't have to worry about the ups and downs of the stock market. There are no price fluctuations that might affect you. You can rest assured knowing that your money will be there long after you're gone. It's tax-free. Yes, investing is tax-free. This is another reason to get on board. It teaches you about business and risk. Investing helps you learn about business, risk, and the market. All of these things will help you become a better investor in the future. It's a great way to make money. Investing is the best way to make money. You can start out with a little and end up with a lot. It's an easy way to save. It is an easy way to save. All you have to do is set it and forget it. It can give you peace of mind. Investing can give you peace of mind. Once your investments are in place, you don't have to worry about them again. As long as the company stays in business, your money will be safe and sound without any additional work on your part. You can use it for retirement. When you invest in stocks, mutual funds, or bonds, they will help you reach retirement faster than if you didn't invest at all. It will allow you to plan for the future. The best thing about investing is that it allows people to plan for their financial future and goals. For example, let's say that you want to buy a house in 5 years but don't want monthly payments until then. Investing helps people like this by giving them the opportunity to invest now so they can pay themselves later instead of paying someone else now and making payments later on down the road when they are ready for their new home or car purchase. Why not invest? There are many reasons why not to invest, but most of them aren't very good reasons at all. Some common reasons not to invest include not having enough money. If you don't have a lot of money to invest, then it isn't a good idea to start investing. You don't have to have a lot of money to start investing. You can start with as little as $25. Not knowing what you're doing. If you don't know what you're doing, then it's best not to do it at all. If you are new to investing, Then seek help from someone who knows what they are doing or look into getting some education on the subject before making any moves. Fear of losing money. There is no guarantee that your investments will make money, and that's why many people are afraid of losing their money when they invest. The only way not to lose your investments is by choosing the right companies and having patience so that your investments can grow over time. It's just like when buying a house. If someone buys the house of their dreams without putting any work into it, they will end up paying more than if they had bought a cheaper home and put in some work themselves. Lack of patience. Investing takes time and patience. So if you lack either one, then it's probably not for you. The longer your investment sits in there growing, the bigger return on investment, ROI, you will get at the end, which means more money coming back into your pocket at the end of the day, which is why patience is vital when it comes to investing. How to save for an investment. There are many ways to save for an investment, but the best way is to use an investment account. An investment account is a type of savings account that lets you invest your money by buying stocks, bonds, or other financial assets. An investment account is particularly useful if you have a high income and are looking to save more money. It's also useful if you have a large amount of money that needs to be invested quickly, such as a lump sum of cash or a large inheritance. There are a few things to keep in mind when choosing an investment account. First, be sure to choose an account that offers tax loss harvesting. This will help you avoid paying taxes on the money you're withdrawing from the account later on. Next, find a broker with low account fees and a wide range of investment options. An account with these two qualities will help you get the most out of your investment. 12 types of investments. 1. The stock market is one of the best ways to grow your money over time, but it's important to have the right broker with low account fees, so you're not paying too much overall in trading fees and commissions. 2. Bonds can be good for investors who want some stability in their portfolios, but they're not as exciting as stocks or real estate investments because they don't typically go up or down much during the year or between years depending on which type of bond you buy. 3. Real estate is one of the safest types of investments because it's both physical and long-term, which means that while there can be short-term fluctuations in price, it should always go up over time if you invest wisely and choose properties that will increase in value over time rather than those that will decrease. 4. Mutual funds can be a good way to get diversification with your investments by pooling together money from different people and investing it in a variety of stocks, bonds, real estate and other assets. 5. Exchange-traded funds are similar to mutual funds except that they're traded on an exchange like stocks are. So you don't have to pay any fees or commissions for the investment, which can make them even more appealing than mutual funds. 6. Real estate investment trusts, also known as REITs, are similar to stocks because they're publicly traded on an exchange, so you can buy them through a discount broker and then sell them when you want to take your money out of the investment. 7. Commodities are also publicly traded on exchanges, but unlike REITs, they include things like oil, natural gas, gold and other physical assets rather than assets that exist only digitally such as stocks or bonds. 8. Emerging market investments are generally considered riskier than investing in developed markets because the economies of emerging markets tend to be less stable than those of developed countries, but at the same time emerging markets may have greater potential for growth since companies there may have more room to grow than those in developed markets. 9. Hedge funds are pools of money invested by wealthy individuals or institutions for the purpose of generating high returns with a minimum amount of risk. 10. Private equity refers to investments made in privately held companies rather than publicly traded ones and is often used by venture capital firms as an alternative way of investing in startup companies since these companies aren't available for purchase on stock exchanges like other publicly traded companies. 11. Venture capital refers broadly to investments made using private equity and refers specifically to investments made by venture capital firms which are typically based on the potential of a new product or service rather than its existing financial performance. 12. Options trading involves buying options contracts that give you the right but not an obligation to buy or sell certain assets at a certain price within a certain period of time and then selling them if you think they're overpriced so that you can make money off their volatility. The benefits of investing. Growth of your wealth. Investing helps you grow your wealth over time by providing you with a regular source of income. The interest you earn on a money market account, for example, is just like the interest check from the bank. Risk management. Investing helps you manage your risk by diversifying your assets across different types of investment. If one type of investment goes up while others go down, your overall portfolio won't be affected that much. Return of investment. The return of investment is a term used to describe how much money you'll make by investing. Asset protection. Some investments, such as real estate, offer asset protection. This means that you won't be negatively impacted if a major disaster strikes. You'll still be able to live an above-average lifestyle even if the rest of the world is hurt by a natural disaster. Investing is worth it. Investing is worth it because it can open up a lot of doors for you. You can gain access to some of the most exclusive parties in the city and attend exclusive events. Saving for a down payment. Investing can help you save for a down payment on a house or for your kids' college education. The things to remember when investing. Don't lose money. This should go without saying, but it's something we should all keep in mind. Always research the investment you're about to buy. This is just as important as not losing money. Don't be afraid to invest in risky investments like stocks and real estate. This is where the most money is made. Investing 101. It can be hard to know where to start when it comes to investing in your financial future. Once you understand some of the basic principles of investing, you'll be able to make more informed decisions. Here are some things you should know before getting started. 1. Investing is all about risk versus reward. Riskier investments tend to have higher rewards, but they also come with a higher chance of losing money. Risky investments include stocks, real estate and other assets that have the potential for major growth over time. If you're willing to take a gamble on your financial future, risky investments may be right for you. 2. Investing is all about putting money in things that will grow faster than inflation over time so that your money will stretch further and further over time as prices increase at their normal rate of 3%. For example, if you invest $100 today, it will be worth $106 in 20 years due to inflation alone, assuming no other factors like investment growth. That's why people want their money to grow faster than inflation, so that they can buy more stuff with their money instead of having it just keep its value over time. 3. The stock market is risky because there is always a chance that an investment could fail completely or lose a lot of value quickly, due to an event like the housing bubble. The stock market isn't something most people invest in for the long term, because it's too risky. The stock market is designed for people who want to make a lot of money quickly, and that's why stocks are so risky. 4. The secret to investing is choosing high-growth investments that you can afford to lose completely, and having a long-term plan. That way, if your investment goes bad, you won't lose much money at all. For example, if you invest $10,000 and it loses 50% of its value, you're still sitting on $5,000, which is actually quite a bit. If you invest $10,000 in something that loses 100% of its value, like the housing bubble, then you will have lost all your money. So the trick is choosing investments that have a good chance of losing value slowly over time, like mutual funds, instead of ones that can crash quickly like stocks or real estate. 5. To make investing work for you in the long term, choose low-risk investments with lots of potential growth over time, not high-risk investments with huge potential gains but also huge potential losses, like real estate during the housing bubble. Choose an investment strategy that combines both low-risk and high-growth potential, like mutual funds or index funds, so that your money will grow more quickly than inflation but also be protected from major losses due to riskier investments like stocks or real estate. Conclusion. Investing is one of the most important activities you can do. It can also be one of the most confusing, especially if you're just getting started. After all, investing can seem like a vague concept that's meant for rich people. But it doesn't have to be that way. I hope that this video has shown you how investing can be simple and how it can be beneficial for anyone. It will take time, but if you follow these steps and invest carefully, you'll make a lot of money in the long run. Thank you for listening, and I hope it has been helpful.